good morning, good afternoon to everybody who's joining us today. Thank you for coming. Today's webinar is hosted by dClimate, and we're going to be talking about how carbon credits are priced and how we can make that process more transparent. I'm Margaret Morales. I direct the carbon program at GreenBiz, and I'm joined today by three experts on this topic of carbon pricing. Alice Mason is the market engagement leader for energy transition at S&P Global Commodity Insights, and her team publishes daily price data on carbon credits. Alistair Ware is the head of environmental products at ABAX. ABAX is a futures exchange and clearinghouse, and it recently launched two voluntary carbon futures contracts, one for JRED and one for Corsia Phase 1 credits. And finally, Shams Ould is the head of carbon finance at dClimate. His expertise includes both project development and financial structuring. And part of what that means is executing investment and sales strategy to channel funds to projects so that they can secure long-term purchase agreements. So that's our group today. We're going to start off with just a discussion amongst this group about the process of pricing carbon credits. Are they a commodity or not? And how the way that they're priced could help to scale the market. Please send in questions as we go. You can put them in the comments chat, which should be in the right sidebar of your screen. Bring them in as we go, and I'll make sure to save 10 to maybe even 15 minutes at the end to take your questions. So with that, we're just going to get right into it, which is how are carbon credits priced? And I think it's important to start with a distinction. Today's conversation will focus on the voluntary carbon market, which has a very different pricing process than compliance markets. So Shams, maybe you could start us off with an overview of how the pricing process works. And I have you on mute, Shams.
Still muted.
There you are. Yeah.
Yes. Hi. Thanks, Margaret. All right. So I think yes, it's important to start explaining the difference between the compliance and voluntary markets. As today we're focusing on voluntary, and sometimes there is a bit of confusion. So the compliance market, to make it simple, is a regulated and mandated program where it imposes to certain covered entities, usually carbon intensive activities such as electricity producers or other industrial companies, to comply with a maximum amount of CO2 that they can emit during a given year. These are typically called cap and trade programs, with the biggest market being the European Union allowance market, which was created close to 20 years ago. So there, for example, if a company were to emit more carbon than their allowance is given them, they would need to buy more of these from other counterparties. So this is a regulated market, and prices today are around, so in the European Union allowance, for example, prices are around $75 per ton. So here we're talking about a very mature, highly liquid market. There are other examples of compliance markets. Just to give another example, we could talk about domestic carbon tax regimes, such as the Singapore one, where again covered entities are subject to a very straightforward carbon tax, which is equivalent to their total CO2 emissions, and price there is currently it's fixed by the government, and it's around $19 per ton, and it's set to reach numbers above $30 per ton starting in 2026. On the other hand, all right, we have what we call the VCM market, which is a purely voluntary market where participants invest in projects that aim at reducing or removing carbon from the atmosphere, and the resulting carbon reduction or removal is materialized by the issuance of by what we call standards of a carbon credit representing 1 ton of CO2 removed or reduced. So unlike compliance markets, these projects and carbon credits are not required by law, but rather stem from, like we said, purely voluntary initiatives, and that involves typically companies with 2030 or 2050 net zero targets. However, what we can say is that these credits still have a final use, as they can, and they are what we could say consumed, in the jargon is retired, by these companies to offset their unabated or residual carbon emissions. So emissions that they have not been able to reduce despite significant efforts elsewhere, such as sourcing, electricity from renewable sources. In terms of prices here, there are different types of projects, so prices vary between a few dollars per ton to more than $1,000 per ton.
Okay, thank you. So I'm curious, like how does the process actually work for a carbon credit to be priced? And Alice, I know that your team publishes daily pricing data. So I'm curious if you can give us insight. Like, what is the process? How are those numbers determined?
Thank you, Margaret. Yeah, there are many different ways that the market prices their voluntary carbon credits. Us at S&P Global Commodity Insights, we have a team of dedicated carbon price reporters all over the world who spend their day talking to buyers, sellers, traders, intermediaries, to find out what levels these credits are moving for every day, where the bids and the offers are, where are things moving, and even in some instances, where are the indicative values, where if people feel is a real true value for these credits. Now, as we've already heard, that's a real variety. There can be so many different types of credits in the market and so many different prices for them. So we have a number of different price assessments for different categories in the market. So that's able to give people, a number for what is the most fungible nature-based avoidance credit going for today, for example. And we're able to provide the market with the differences between avoidance and removals credits. But really the way that they trade in the market is like any other, commodity that we see. It can either go from straight project developer straight to a retiree, and they retire the credit straight away, or we can see them trade in the secondary market between different trading houses or buyers and sellers, and these credits can change hands as many times as possible before someone decides to retire it, and then it's the end of the lifespan of that credit.
Okay, so that is so it could be the majority of credits, as I understand it, go straight from a project developer, someone representing a developer, to an end buyer, and they're going to negotiate that price together. Or it could go through some intermediaries, like you were saying, and those intermediaries would be like a broker, or who else would be in that category?
Brokers, trading houses. You may even get some end users who buy too much supply from an offtake and then resell it back into the market. And there are a lot of, large banks and trading houses that are involved in the carbon credit market, trading in between and building up positions in this market. So a variety of players.
Mm-hmm. So I suppose taking a step back, so that's setting the price, but first, the first step is, what is the cost of creating that carbon credit, right? That whatever the price is has to at least hopefully cover that cost. So Shams, do you want to talk a little bit about, essentially I consider that like the bottom up process. What's the cost? So how do you see that work?
Yes, thank you. Since we're talking about projects, there is a cost involved to developing these, and we mentioned the word commodity earlier. So like traditional commodities, there is a a process for those credits to be created, produced in a way, and purchased. And there is a project cost, which is what we would call the abatement cost. So you would look at how much the project is going to cost during its entire life. You would also look at how much carbon reductions or removals will be created, and you'll get your price per ton. So that would be your abatement costs. So there you have your I would say typical project costs. So we have development costs, including materials like, for example, if we're talking about an NBS project, like seedlings. You have labor, equipment, monitoring, reporting, and verification costs, and other fees. So you have to take all these into account, and that would basically generate your unit cost price, which is the floor at which you'd like to sell your credits going forward.
So, Alistair, can you share a little bit about where does AVEX or an exchange like AVEX come in this process?
Sure. So I think what we're really trying to solve for is kind of price discovery. So if you look at, let's say, the voluntary carbon market today, north of 75% of all transactions take place on an OTC basis, or kind of a bilateral trade between two counterparties. That process doesn't facilitate that much in the way of price discovery, i.e. pricing remains opaque and confidential between those two counterparts. What we're trying to do is bring the fundamentals of, let's say, traditional commodity markets processes and apply them to carbon markets. And we've done that by creating, to begin with, 2 voluntary carbon futures contracts. The first of which is a CORSIA phase 1 contract, really kind of focusing on the needs of airlines and the aviation sector. And so we've defined a deliverable basket of eligible credits that would be usable for CORSIA phase 1, as outlined by ICAO. And we create a process by which you can bid for or offer credits into that contract. So we provide a 13-month curve, so from December of 24 through until December of 25. And as a supplier or buyer, you can have some sort of understanding of what the cost of a CORSIA credit is going to look like in that time period. We've done the same for jurisdictional RED, which is a program, a nature-based avoidance program, and very much taking the same process, tried to create a price curve that allows for project developers to understand what their projects are going to sell for at some point in the future. That's particularly useful for project developers as they look to hedge their price risk exposure, and gives them a way to kind of mitigate the volatility of pricing over the coming years and months. So that's kind of the first aspect of what we're trying to do. The second is really catering to the challenges around counterparty risk. So in a nascent market like carbon, buyer and seller don't necessarily know each other. There are, let's say, hurdles to overcome in terms of onboarding counterparts. And there is a real breadth of counterparts. I mean, thousands of firms globally that act as project developers, project financiers, trading firms, etc. And to streamline the process of trading between unconfirmed counterparts, we act as effectively buyer to every seller and seller to every buyer, streamlining that process and guaranteeing the financial performance of a transaction, which should allow for more trades to take place and a bigger pool of eligible pairs.
Okay, so 13-month price curve. So if I'm a project developer, I'm working to get some credits issued in the next 13 months. I can see maybe what those might sell for. What data are those curves based on? How do you make that prediction?
So those are based on real bids and offers. So at the end of every day, we assess bids and offers, and that gives us an indication of an end-of-day settlement price. So somewhat different to Alice and S&P, where they, I guess to a certain extent, ring around the market and ask, okay, where do you think the market is? Ours is somewhat less subjective in that it's based on real transactions. And the intention is with time, you build out a bigger curve, because obviously in a project that has a 30-year life cycle, there's marginal utility for a 13-month curve. But if you've got, let's say, a 5-year curve, then that starts to become of real utility to the market as a whole.
Okay, and to be clear, right now you produce a 13-month curve, but are you saying in the future that the goal is to produce a longer and longer?
Exactly. So the challenge is when you're creating a curve, you need sufficient bids and offers, you need sufficient liquidity. And so at the outset, you need to kind of concentrate that liquidity in a range that allows for initial price discovery. And as liquidity builds, there's more indication, you can build out a deeper, longer curve.
Mm-hmm. Okay, and just to put a fine point on this, I think you said perhaps north of 75% of all carbon credits sold today are OTC or over the counter, which means you don't have data. There is no public data on what those sold for. Is that correct?
That is correct.
Okay, so that is a wonderful segue into the second big question of our conversation today, which is, are carbon credits a commodity? And I hear and read very interesting opinions from a lot of people on both sides of this. And so I'm some that talk about how, carbon projects are bespoke. It takes a tremendous amount of work, especially nature-based carbon, well, any kind of carbon project. There's community engagement. There's a very specific ecosystem in which that is happening, the specific social and political dynamics. That could make it hard to treat them like a commodity. On the other hand, there could be benefits to treating them like a commodity. So I'd like to hear from each of you. What would it mean for a carbon credit to be a commodity? Like, what does this question mean to you? And do you think they fit that definition? And Shams, maybe you could start.
Yes, thank you. But to me, the answer is obvious. It is a kind of commodity. Sorry. So just if we look at the life cycle of a carbon credit itself and its characteristics, it is acting the same way as a commodity. Like we have a production / growing process, then you have an export and transportation phase, and then you have an end buyer that is going to use those credits to and retire them for their own carbon footprint, the same way as you would get your coffee at the end, and it's been brewed and you drink it, and that's it. And I know you mentioned that it might be complicated to make credits fit in that box because they are so bespoke. But again, if we are looking at, let's say, coffee, which is a commodity, it's similar to a carbon credit in the sense that we talk about nature-based solutions projects having co-benefits, whether it's impacting local communities or, let's say, restoring natural habitats. Coffee is also, you have growers that are often in remote areas, and when you have a large company, for example, like Starbucks, that is sourcing coffee from Nicaragua, not only do they buy coffee from there, so in the same way as a company would buy credit from a project in Nicaragua, but they also invest in the community of growers by reinvesting money in infrastructure. So to me, it's the analogy is crystal clear. There's another analogy or comparison. Fortunately or unfortunately, we have the same dynamic in the sense that commodities typically are bought from global north countries, and they come from global south countries. And in the world of carbon credits, we are seeing the same thing is companies or counterparties in the global north buying credits that come from projects located in global south country. Sorry, and one last one reason also why I think we need to treat it more as a commodity, and this is how we see it within dClimate. It is necessary to scale the markets and to see it as a commodity and to make it more like an institutionalized underlying, because it would bring, and we see it with the likes of Abex and S&P, it would bring more traditional investors, such as commercial banks that are, looking to invest in new sectors, and more importantly, in sectors that would make their portfolio greener and contribute to fighting climate change.
Okay, Alice, what about you? Do you see carbon credits as a commodity, and why would this matter?
Yeah, I very much echo the sentiment. How we treat the carbon markets, both voluntary and compliance at, S&P, is to follow the same methodology, the same principles as we apply to oil, to gas, to metals, and even protein. So we very much view it as a commodity, and we're putting forward those same processes. And we've heard the coffee example, but also from a metals example, if we took it, where every metal has a different brand, some have different purities, they sit in different parts of the world. There are even vintages to some extent, old metal versus new production. So the nuances of what makes each carbon credit unique has been seen, throughout time in other commodities, and can be traditionally dealt with if we are willing to kind of package projects together in groups and have, a price for segments. And of course, there will always be premiums and discounts within that segment, but that's the same for many commodities all over the world. So definitely, we see it as a commodity, and I agree that's how we can scale, the market, because it's also about, one of the things the carbon market continues to tell us is there needs to be an increase in trust in this market. And treating the voluntary carbon market as a commodity and putting things in place where there can be price references, price transparency, increased liquidity, are all things that can embed trust back into this market and help investors and growth long-term forward.
Okay, this idea of creating packages, I think is the word you said, is interesting. What comes to mind for me is, you would say, here's the fair price for an afforestation credit. It's X. Or would the packages be even more specific than that, like an afforestation credit with these additional attributes?
The way we look at it is for there to look at fungibility. So in that group, so in afforestation, what is the most liquid and the most fungible? You don't want to just have the cheapest price, but you want to have something that everyone can buy, that's accessible to everyone and meets a certain amount of requirements. So it's about picking a group of a segment that's really fungible and relates to the market, and they say, okay, that's reflective of a standard credit in that segment. And there's many different ways of doing it, but if we continue to look at everything project per project, the market is far too segmented, and that's when we move away from this idea of it being treated as a commodity. Because in order to be a commodity, we need to look at pricing it from segments, maybe even in the future regions. If different projects are priced differently per region, maybe there are benchmarks per region. And we heard about costing, abatement costs, how much some of these credits cost, and that's also an important factor, right? A BECS project in the US may have a significantly different costing to a BECS project in Europe, for example. So we have to look at how we can sensibly come up with price discovery in regions and segments, but in a way where we group liquidity together as well.
Yeah, I think that issue of it costs a very different amount to develop the same kind of project in different countries. And even a project developer may execute on their project differently in terms of how much of the revenue goes to the local community, for example. And that would massively influence the cost of the project. So I wonder if you all see a risk to treating carbon credits as a commodity, in that tell me if this is true. This is something I have heard. More of the margin is taken by players in the middle than by the community and the project developer who's actually doing the work to create that project. And Alistair, I'm curious what your perspective is on this.
Yeah, I mean, that's an interesting one. And I think that over the last couple of years, there's certainly justification for pointing the finger at intermediaries and an insufficient flow of proceeds kind of ending up at the community level. And I think a lot of that falls down on the lack of price transparency, i.e. project developers had no idea what their project was worth at the outset, and maybe missold it. I think there's certainly an argument for that. But equally, I think there is a justification for people that are taking risk with their own capital, getting a return on that investment, right? So if you're buying projects as a speculative asset, you can, in theory, see both price appreciation and also incur losses. In other commodities markets, if you look at, say, crude oil, for example, the number of times a shipment of crude oil trades hands between loading and destination is north of 30 or 40 times. In carbon markets, we're maybe seeing 1 or 2 turns of a credit before it's retired. So i.e. it goes from project developer to first off-taker to second off-taker to eventual retiree. I think with time, we're going to see more price transparency. And so margins, in theory, are going to be squeezed. And hopefully that will lead to the original project proponent getting a fairer value for their project, and equally allowing for more money to flow to projects to begin with, because there's just a better understanding of what things are worth and what people are willing to pay for them. So the risk that any speculator is taking is somewhat reduced.
Interesting. So by having a higher percentage of carbon credits that are sold happen over an exchange where data is transparent on how much the credit was sold for, it may help investors feel more confident to invest in a project. However, okay, you're saying that for oil, maybe it changes hands 40 times. So I would think that's 40 additional players there who are each need to make money on their work. So, and right now that process for a carbon credit is maybe around 2. It changes hands 2 times before it's ultimately retired. If carbon credits are treated more like a commodity, wouldn't we expect it to trend more to a more similar process as oil? In other words, there are more parties in the middle between where it starts and where it ultimately ends.
So I think, yes, you're going to see more parties in the middle, but I think the net margin of intermediaries is going to be substantially squeezed. If you look at, say, the profitability of the major merchant trading firms on their energy businesses, they're probably less than 1%. So they're operating on very, very tiny margins at massive scale, right? So if you look at, say, a Vitol or Trafigura, their revenues are in the hundreds of billions of dollars. Their net margin is in the range of 1%. If you compare that with the voluntary carbon market, total market size is what, circa $1 billion US. But the marginality of firms within that is probably north of 30, 40% as a guess. So I think we're going to see probably a reduction in margins, but probably much bigger volumes being traded. Mm-hmm. And consequently, we're going to have better price discovery and a more efficient market.
Okay. I'll just take a quick second to say to everybody joining us, we'll continue this. I'll continue grilling our panelists for another 15 minutes or so, and then I'll leave the final 15 minutes for your questions. We're getting some great questions in the comments. I think also, I believe this is being streamed on X and LinkedIn. And so if you're watching on there, I believe you can also submit a question in those platforms. So I want to go back to something that Alice mentioned before about grades of a commodity. Like you might have the same type of carbon credit, but it could be of various levels of quality. And so how that would impact the price or even a discount. And Shams, I'm curious if you could speak to that.
Yes, no, thanks. It is also, if we want to keep having the same analogy, in the commodity world, you have price benchmarks that are used as a reference level. And then depending on the quality or the grade of that specific commodity, you'll have premium or discounts. And in the world of carbon credits and projects, you could think of the same, having publicly available price sources that would set the tone and would be used as a reference. Let's say if it's a Red Plus project, you will have X price to it. And then depending on the vintage, i.e. when the emission reduction was accomplished, the jurisdiction, you can also have all the other co-benefits and added certification, you can have discounts and premium. But the goal here is to bring, so when we talk about transparency, is also bringing more visibility and accessibility. Having features now available, even though curves are still short loaded, we legitimately can expect that this will increase certainty also, because in order for investors to feel more comfortable, you need a certain level of certainty, which is brought by making sure that you know how to price your credit. And I think Alice there, alluded to it. The fact that there's a lot of intermediaries here is also because the end buyers don't want to take the risks yet. They want to wait until basically the credits are delivered to them. And for this, you still need money to be invested in those projects. You still need somebody to take that risk, whether it's a project developer, a broker, a trading firm. You still need, because you're taking that production, that growing phase risk. So you're putting money today for credits to be delivered in a few months, in a few years' time. So until we have that, that's why we need to bring more traditional participants, the participants that had been heavily involved in commodity space, because they know how a market works, they know how to manage risks, and they know how then to mitigate those risks, so that you have fewer intermediaries and more money into those projects.
Okay, so we've spoken a little bit about how it works today, what it would mean if carbon credits were treated more like a commodity, the opportunity for bringing in more finance, perhaps better clarity even for the developers. I want to spend a few minutes talking about what is the path from where we are today, to maybe a future in which carbon credits function more like a commodity. What would need to happen and who needs to do what? And Alice, maybe you can start about who are the stakeholders in this ecosystem and what would need to happen?
Yeah, I think there are a lot of stakeholders. I think, price reporting agencies like S&P Global Commodity Insights play a big role in being able to, put that pricing information out there and increase the transparency. But that goes hand in hand with futures exchanges as well, to be able to create the forward curves and the risk tools needed for people to invest, right? So there are a lot of things in terms of people, when they come to getting finances for some of these extremely expensive projects, they need price references that they can trust. So they can say to the banks, look, this is what this project could be worth. And for them to hedge against the risk as well, they need the forward curves and the exchanges. So I think all of the people on this call also go hand in hand. So there's not one single solution, but we also need to things like the CCP labels, the core carbon principles, things that will also bring trust to the market in the credits that they're buying. So people can, you want the intermediaries and the traditional players that Shams decide to step into this market. But at the moment, there is risk. There's reputational risk for some of these companies, there's, you know, concerns. So the CCP labels from the ICVCM should address that. And hopefully, you know, people will feel more confident. The price discovery tools and transparency brings the trust again. And we should, you know, it will take time, but we all treating it like a commodity from now on, I think, is a good step forward, and we're implementing the right tools needed for that to happen.
Alistair, what about you? What do you see as what needs to happen to unlock this future?
Yes, I think I'd echo much of what Alice has said. Maybe I just want to touch on kind of the claim side of things, the role of VCMI. I mean, at the end of the day, a carbon credit exists to be used for a specific purpose against a specific claim, right? And until corporates have real confidence around the kind of claims they're making, and they have guidance in terms of what claims they can make for the use case that they have, I think we're still going to see carbon markets struggle to reach the kind of scale that the likes of McKinsey have alluded to. And so I think there's twofold. One, it's really a kind of framework from somebody like VCMI, but also a fair amount of legal certainty. And I think we've touched briefly on kind of the legal nature of carbon credits, but there's also the kind of legal certainty and legal protections that are afforded to firms that are voluntarily making claims, and the claims that they're making. Because we've seen over the last couple of years, some of the more proactive entities be hit with lawsuit after lawsuit. I'm kind of thinking of the likes of Delta and others. And without that sort of legal certainty and legal protection, I think we're going to see firms remain somewhat reticent to deploy capital, and to be sourcing credits at the volumes that we all hope and expect to see.
That's very interesting, the idea of a legal protection for a company making a voluntary claim, voluntary climate action. Do you have optimism, or do you have any signs you're watching for that something like that might actually happen in the near future?
So I think in the EU, we're seeing a rule book around claims beginning to be drafted. And I think that more kind of goes towards carbon neutral claims and carbon neutrality as a whole. But just having legal certainty around the language and words that you're allowed to use, I think is a very important starting point. Obviously, I don't expect legal certainty to be resolved overnight, but I think it's something that's incredibly important, and hope that the regulators in the kind of relevant jurisdictions, whether that's Europe, US, China, and elsewhere, will kind of recognize the significance of this.
Shams, I want to give you a chance as well. Who needs to do what for carbon credits to function more like a commodity?
I think we need increased due diligence from market participants, starting from project developers, investors to end buyers, and this is within the supply chain. So from the development side, so better data, relying on new technologies that are now available to speed up the monitoring, reporting, and verification process. That will be available to all stakeholders, and we are seeing now a move towards increased use of digital tools, whether it is by standards or by investors. On the due diligence side, also, what I wanted to add is we mentioned legal protection, but buyers need to be much more stringent in the way they look at projects. And sometimes, just to be optimistic, buyers and users of carbon credits overlook certain risks and aspects, and being more diligent, making sure that the proper legal documentation framework is put in place is a way also to make this a more institutionalized market.
That's interesting, Shams. I want to push on that a little bit, because right now, if a company is going to buy some carbon credits and they're going to do it over the counter with a direct relationship with the project developer, the amount of due diligence that they might undertake could be enormous, an enormous cost of time and money. And either they're equipped to do that in-house, or more likely they're going to hire a third party to help them create their framework and then evaluate projects, blah, blah, blah. I would think if this moves more to a commodity market, an end buyer, when I buy a cup of coffee, I'm not evaluating if that is good or bad coffee. I see the label, I see it's maybe fair trade or whatever. That gives me an indication that this, or I don't know where it comes from or something like that. That gives me an indication I'm not going out and doing my own due diligence. So I'm surprised that you would say due diligence on the part of the buyers will help move towards a commodity market. I would think part of the benefit of a commodity market is it takes that burden off of an end buyer. Is that correct?
Yes. Here, the due diligence from the end buyer is when they invest directly, not when they are at the very end of the supply chain, just buying credit from a reputable seller, the same way as you would buy your credit from a reputable roaster company like a Starbucks. You know their coffee might not be good, but you're not investing in the production of coffee. So I think there are two ways of looking at it. One is whether is having within companies that are willing to purchase and invest in credits, more people with more experience in those types of projects. So having dedicated, I would say, a workforce dedicated to it. And it's also the other way, as we've seen with a lot of blue chips companies willing to invest and buy credits. They delegate this whole due diligence process to third parties, but those third parties are investors, like impact investors, that will also do a huge amount of due diligence. So they will rely on the local project developer, but they will do another, I would say, technical analysis, market analysis, and the same way as a financial institution is going to lend money to a renewable producer, they will rely on the analysis that is going to be provided by this producer, but they will also conduct their own assessment of how risky the project is. And I think this is what I mean when I say that we want to make it look like more like a commodity is the amount of expertise that is required and to invest, and not just blindly rely on intermediaries.
Okay, we have gotten so many good questions in the comments. So thank you to everybody who's sending them in. And I'm going to move on to these now. And I want to start with a question from Juan. And Alice, I'm going to direct this one for you to start. The question is, sometimes there is a disparity between the bids and the indices for carbon credits, since most are over the counter, OTC. How can we close the gap?
That's a really interesting question. I think there is, maturity of markets come into this. We are still, in an early phase of the carbon market. And as we become more mature and the transparency increases, that gap will naturally close as well, because the trades that happen OTC will become more widely spread information. You also will have more of the intermediaries that we've spoken about, a larger secondary market versus the single offtake market, which difference between the spot and the long-term contract trades are different. If you are buying a whole project and you're taking every credit that it's going to deliver over the next 5 years, versus if you're buying a few thousand tons on the spot market, those prices are quite different, and we look at specifically the spot market, which is the secondary market. So I think we'll see a natural convergence, but also that will be down to increased transparency and increased liquidity. The more trades, and Alistair alluded to it earlier about being based on trades and high quality data being actual trades versus bids or offers or indications, the more liquidity we see, And the more, transactions in the market, the more aligned they'll be, because I mean, we all know that some of the bids could be extremely low and just be chucked out in the market. And that doesn't mean that a project developer is willing to let go of their credits at that level. So that doesn't mean that the bids that we see on some of these platforms are reflective of the market, right? And that comes back to, again, full circle, but costs of the project and abatement costs and everything. So yeah, I think it will be maturity, increased transparency and liquidity, which are all things that we've spoken about already.
Okay. Another really good question here. This one's from Will. And the question is, if carbon is a commodity, how do we prevent pricing falling into the same trap as other commodities, creating a race to the bottom with most margin taken by entities which are not the local communities and the landowners that are generating the benefits? And this is something we talked about a little bit, but Shams, I'm curious if you want to take this to start.
Thank you. Very good question, indeed. So one of the differences is that when a carbon project is being developed, you need to have two things. One is properly documents how much money has to go back to the local communities, and this is I think paramount to the success of community-centered projects. The other thing is also to make sure, or to I'm going to insist on the due diligence, but to make sure that within the country there are also appropriate carbon trading laws in order for things to be transparent. So this is a little bit how it could differentiate from the typical commodity world, is that you need regulations as to how much money you would need to bring back to the local communities. And we took the example of Starbucks earlier. When they buy coffee in Nicaragua, nothing compels them from investing and building schools or roads. But in the carbon space, this is actually a requirement, especially when you do forest preservation projects. You want to avoid deforestation by providing alternative ways for the local communities to live, basically.
So essentially, wrapped up in the commodity itself is a requirement for a percentage of revenue to go back to the local community.
Absolutely,
Alistair,
and the high, and then it's a percentage, and the higher the price, the more you give back to the communities.
Alistair, I'm curious for your thoughts as well about this race to the bottom and how to prevent it.
Well, maybe it's worth, I think, taking a step back to begin with, right? And thinking like, what does a carbon market, or what do carbon markets exist to do? And I think the initial concept is really around the most efficient allocation of capital, i.e. deploying capital to achieve the greatest climate impact. And so fundamentally, what we're trying to do is secure the maximum tonnage for the lowest price. That may be perceived as something controversial, but I think fundamentally, at the end of the day, if we're going to hit 1.5 degrees, we've got to be relatively efficient, or extremely efficient, in the way that we deploy capital. And if you look at, say, DAC, there's a reason why there's limited capital flowing to DAC at the moment versus, let's say, avoidance, because at this point in time, you're going to have a much greater impact with the same amount of capital in nature-based avoidance versus DAC. That doesn't mean that we shouldn't be deploying capital into DAC. That just means we should be doing everything, both DAC and all sorts of other things. With regard to a race to the bottom on a project-by-project basis, I think what we see in, say, futures markets is often a criticism that a futures contract is designed from the outset to allow for the cheapest to deliver, i.e. people are only going to deliver into that contract the cheapest possible project. The reality of the matter is that actually the utility is not so much in being able to deliver into the contract, but having that price curve that you can price basis off. So if you perceive that your project has a significant number of SDGs and is worth more than our price curve is indicating, you would negotiate on a bilateral basis, and you'd say our contract is, or our product is worth the ABEX jurisdictional red contract plus $10 or something. And what you're trying to do is negotiate that basis between buyer and seller to come to some sort of agreement of what you think fair market value is. So yeah, maybe my 2 cents on the kind of the challenges around cheapest to deliver and a race to the bottom.
Okay, very interesting. We got a really good question here from Alfred. From a project developer or seller point of view, what advantage is there to show the price on the market? And Alice, maybe you could start with that one.
Yeah, I think the audience are already, treating carbon as a commodity, as we get this question across, all of our commodities. But there's various reasons. And I think the first is for, we want project developers and sellers to transparently see that they are getting a fair price for their credit, right? And if nobody shares the price on the market through an exchange or through a price reporting agency, how does anyone know that they're getting the maximum price or a price of fair value for their credit? Another reason is, as you pull into the further down the line, as we get to a stage of having benchmarks and references in this market, sellers and project developers, instead of having to lock in the same project price for 10 years or however long their offtake is, could say, look, we could base it off, S&P Global Commodity Insights number, a monthly average, a quarterly average, whatever they want it to be, knowing that the S&P number is reflective of the spot market at that time. So you didn't have to lock in $10 for the next 10 years. If people are transparent and they show their price, you could be able to price a long-term project and incorporate any moves. And of course, there's risk up and down, which is why you need risk and hedging tools. But there's the ability to be more flexible with contracts. And again, if everyone shows their hand, more transparency in this market.
All right, thank you very much. And I liked Alistair's comments on that earlier as well about potential benefits to a project developer to have more data about what their credits may sell for in the future. Okay, I want to turn to another question, and Alistair, I'll ask you to start on this one. So the question is, I think there is an argument to be had that carbon credits are not a commodity. The reason being that most of the risk of the credits are not transferred from supplier to buyer. This is different than timber, as an example, where once it moves to the buyer, the transaction finalizes for the most part. Alistair, what would you say to that?
So, from a legal standpoint, I think if you look at different jurisdictions, we're seeing a variety of different approaches. A lot of jurisdictions are looking at them as securities, intangible property. Only a handful are looking at them as being pure commodities. I think what we're trying to achieve, and I think the other panelists are, is not necessarily the creation of a commodity per se, but to apply some of the learnings and benefits from commodities markets to an asset class that could benefit from some of those tools. And whether that's price discovery or the way that they're transacted, you can perhaps apply some of the lessons learned from commodities markets. But clearly, as this question has referred to, they have a certain nuance that doesn't make them entirely similar to other commodities. And that particularly goes with the kind of intangible nature of it and what happens when you retire a credit. So yeah, maybe I'll let some of the other panelists have a stab at that as well.
Mm-hmm. I think insurance perhaps has a role to play here as well. And Alice, I'm curious what you're seeing in terms of those trends.
Yeah, really interestingly, we have seen insurance products, arrive onto the market. We know there are some parties offering insurance, and we see a growing number of interest, especially if we look to things like the Corsia scheme. At the moment, there are credits that have a promise of a corresponding adjustment, and we have had lots of discussions on the right to revoke. And there are buyers looking at if they could buy an insurance product that would protect them if, you know, the corresponding adjustment was revoked. So I think there is a role to play in insurance here. And from, you know, a trader told me the other day that the price of insurance it hasn't broken the bank anyway, that he said it was quite a realistic offer they got for the insurance and they felt it was, you know, a fair price. So, you know, maybe that's something that we see develop that brings the confidence and, you know, touches on that risk element. And again, this is, you know, we're treating the market like a commodity. Every commodity has its nuances, and maybe, you know, insurance being an aspect of this market and an aspect of the price is going to be, you know, something that the market will evolve and help it go forward.
Okay, well, we have just a few minutes left, so I want to give each of you a chance to say a closing comment. And my question for you is, if you could wave a magic wand and make something happen in the voluntary carbon market in the next 12 months, what would that be? And Shams, I'll start with you.
Tough question, but what would that be is bringing more trust and confidence in the market, using new tools that are available and emerging, like you know, digital tools or futures platforms. But one thing I want to point out is those projects ultimately they are here to fight climate change and to reduce or remove CO2 from the atmosphere. So we always have to keep that in mind. And carbon credits, they can be viewed as a byproduct of those projects. You know, we, for example, at dClimate, we focus on forest preservation, and we you know, a forest preservation initiative has three main goals. One is to avoid CO2 emissions. Second is to improve livelihoods of local communities. And third is to restore natural habitats. So the way we've been talking a lot about commodities and capital allocation, it has to be used in a way to bring more money to these projects, keeping in mind what the final goals are.
Okay, Alistair, what about you? What's your wish for the next 12 months?
So I think my hope is really that the market as a whole wakes up to the reality that this market is not quite as dysfunctional as the critics may have made it out to seem. I think the voluntary carbon market over the last 12 to 24 months has been through a pretty rocky phase. But my perception is that I think really there's light at the end of the tunnel. The tools that the market needs to function properly are already here now, right? So whether that's guidance from ICVCM around CCP labeling, VCM guidance around claims, there's been kind of big leaps forward in technological innovations. I'd argue that really everything that a market participant needs to proactively deploy capital, to buy offsets, to make retirements is there. And so I hope that we see a more active market and that participants really follow through on some of the promises that they made historically. I mean, really, time is of the essence. 2030 is just around the corner, and we need to be doing everything we can to meet some of those climate goals. And so really, it's just a matter of stepping up engagement and activity. And I hope that we'll see that over the coming quarters.
The time value of action, I think, is very real when it comes to climate change. All right, Alice, I'm going to give you the final word.
Yeah, I echo both of those sentiments. I think, you know, the magic wand would be to increase liquidity significantly in this market, but also to have the funding for these projects that are needed across the world, right? There are so many areas of the globe where they are looking into investing in important projects. They haven't got enough financing. Certain technologies are far too expensive to invest in. So if you had a magic wand, you'd give the capital needed to really boost this market and us have more of these variety of projects across the globe.
I think that's a wonderful closing word, which is if the voluntary carbon market can help close our climate finance gap, I couldn't imagine a better use in theory of change. So with that, a huge thank you to dClimate who helped put this together today. They will be sending out this recording to everybody who signed up. So you'll get to relive the conversation anytime you want to. And also thank you to everybody who joined. This has been a wonderful conversation. Thank you to our panelists for your insights today. Have a wonderful afternoon.
Thank you, everyone.